All right. Good afternoon, everyone. I've got Tim Foote, CFO of BlackBerry with us. Thank you.
Hi, Dan. How are you?
Good, thank you. So, you guys have been undergoing a lot of transition at BlackBerry. You've now segregated the two businesses. We can see each one as of your last investor event. How do you run the businesses differently? Is each company allowed to manage its own cash flows, how they use them, and how are you thinking about capital allocation between the two businesses?
It's a great question. Yeah, the transformation that's happened in the last 12 months, I think, has been quite significant. We've taken a lot of costs out of the business. So around about $135 million has come out of the run rate. We've narrowed what was a significant cash burn towards where we expect to be cash flow positive in our fourth fiscal quarter of this year. So this time last year, we burnt 56 million in the quarter. And we're aiming to be positive. So significant progress. On your point around the operational side of things, so we have two fairly distinct businesses. We have our IoT division, which is largely centered around the QNX product, which anyone who's familiar with automotive in particular will know very well. And then on the other side, we've got our cybersecurity business, which is a combination of a number of different assets, including our endpoint management and our silence business. So they address very different markets, Dan. They have very different go-to-market motions. And part of this exercise to stand up two standalone divisions was really to give focus to each of the divisional leaders. So that allows them, to answer your question, after a very long-winded introduction, to make nimble decisions. So what we've done is we've delegated a lot of authority to the leaders. So you've got Matthias Eriksson on one side and John is on the other side. No longer do they have to go to the corporate layer for so many of the things they want to do. So that's any spend decisions, hiring decisions, real operational freedom to focus and move nimbly within the markets that they serve.
Well, that sounds good. Any lessons learned as you were going through this breakup process?
Yeah, so one of the things we were very keen, and I've heard it a number of times as a question, is have you introduced a bunch of dis-synergies by doing this? And clearly where we got to a position where we could have veered towards dis-synergies, we've taken a step back. So for instance, we were looking at our IT infrastructure. So do we really need to have two networks? You know, you could take this to a very purist level of separation. Does it make sense to have two IT networks? Well, no, it really doesn't. Not at this stage anyway. So we got close and we've kind of stepped back in certain areas. But generally speaking, we're very happy. I think if you speak to the likes of John Wall and Matthias on the IoT side, I think they've got a level of freedom that they've not had before.
Now that you got most of this transition behind you, you've released the results. The stock continues to perform as is. How do you think you unlock shareholder value here now that you've separated the businesses? What would you like investors to focus on?
Yes. Okay. So I think there's still some nervousness around the stock as being somewhat of a show me story, and right or wrong, that's where we're at. So whilst we're talking some significant improvements, they want to see it come through in the numbers. Now, one thing that I'm pleased about is that it is starting to come through in the numbers. If you look at our OPEX, it's down significantly. We gave a baseline of 130 million a quarter. Our last quarter, we hit 100 million. So we are making significant moves, like I mentioned, the cash burn. I think as part of this overall process, the separation process, it allowed us to dive a little bit deeper and peel back a few of the layers of the onion, Dan. And we noticed that the silence business within the cyber division itself has a very different financial profile from the rest. And I think quite often when I speak to investors, the feedback is that the cyber division in its totality is actually not performing. It's not a good asset. Why don't you just divest the whole thing get $1 and move on? Well, actually, if you dissect it and look at it closer, you see that 3/4 of that division, which is UEM, Ad Hoc, and Secusmart, is actually a solid, slightly growing, decently profitable EBITDA percentage around about 20% business. And then you've got the Silence business, which obviously we'll probably come to, which has got a different profile. So I think there is value to be had in there that it's not often recognized. And as part of this process, I think we've helped shine a light on it.
Yeah, maybe we can dive into the cyber business before we jump into QNX, the crown jewel. Everyone knows QNX is doing well, but for me, the most interesting thing that came out of your investor event was that Silence view, because remove Silence and the rest of it looks pretty good. So when you say decent growth, 20% plus EBITDA margin, what is that growth profile like? And what is in that non-Silence purchase for those that don't fully appreciate how sticky it is?
Yeah, of course. So the three businesses, like I mentioned, Unified Endpoint Management, which is a fairly mature business. It's been around for a while. It does have some fairly healthy competition in cloud deployed environments from Microsoft in particular. It's seen some churn, but where we're at now, Dan, is this is a business that does have some elements of the market where it's actually quite sticky. And that's particularly in things like on-premise solutions, where if you've got a data sovereignty need, then you're probably going to turn to the BlackBerry for that. So that's seen some churn. There'll probably be some churn in the customer base, but we pick up a few others. So net is kind of relatively stable. Ad Hoc, which is a critical events management platform, that's a much more growthy type of part of the business. That's, for anyone who's not familiar, it's like Amber Alerts on steroids. It's very strong in the US federal government itself, but where so much focus has been placed on Silence in the past, maybe we haven't pushed as hard into some of the near adjacencies as we could, state, local governments, governments around the world. So we see a pathway there for some growth on that side. And then finally, we got Secusmart, which is predominantly German-based. It's encrypted voice. And we're talking like incredibly encrypted voice capabilities. It's used by leading governments. It's used by NATO. It's like CIA, people like this. So it's very, very high level of security. Again, it's not really an awful lot of competition for this product. So it's really it's defining the need with the customer. And then when you can define that need, we feel like there's potential for growth there. So you've got UEM, a little bit of churn, Ad Hoc, and Secusmart with potential for growth. You put those three together, and actually, it's, like you say, solid business that, and it's generating profit as well.
Yeah, and I think the important part here is it's a lot of government contracts which don't churn that much, and once they're set on a very secure, stable solution, they stick with it.
Yes, that's true. I mean, Ad Hoc in particular, its renewal rates are some of the best in class.
Yeah,
very high.
Now the Silence piece, obviously a little bit of an outlier. It's not government based. You guys said in the last investor day that you were looking to pursue strategic alternatives for it. What are you considering here, and what drove that decision? Why now?
Yeah, it's a great question. Obviously, we've got a new management team, and one of the good things about that is that anything that's come before is effectively sunk. So we take a view: where are we today? Where can we go from here? What are the best decisions that we can make? So, you know, from the point of acquisition, the market moved away from that technology, and Silence was really playing catch up, and that's particularly around the EDR capability for anyone that's familiar with that. And what we're left with is a business with some really good technology. The developments that Nate Jennigers and the team have put in place, really very good. However, where we find that business now is it's effectively quite subscale. So we're left with the decision: what do we do? Do we try to grow it back to scale, which we've seen many other players in that market do? But in order to do that, you're going to have to widen that loss from the 50-ish million that it's at currently and we'll probably have to do that for a meaningful amount of time. Well, given that we've got QNX in the portfolio, it really doesn't make sense. It would be a level of commitment that we're not really willing to tolerate. So at our investor day, we said that we were going to take some actions to cut costs in the near term as we kind of pivot our focus away from Cylance somewhat. And we've done that. We'll update more earnings. And then in parallel, we'll look at what opportunities there are for that business out there. Obviously, I can't go into too much detail on that here. But let's just say we'll explore whatever avenues we can explore.
Sounds good. Are there any questions? So I'd like to pivot into the QNX side of the business. Obviously, very good competitive position. I've been a big fan of the software for a long time. You're a market leader here, and there are several growth tailwinds, but this year's been challenging. Just the overall automotive space in particular. Can you provide investors with a little bit of a refresher on where that business stands today, and any update on some of those short-term macro issues?
Yeah, so this is a really exciting business. It's one I really enjoyed talking about, and hopefully I get to talk about it a lot more in the future. So essentially, it is the market leader. It's the number one in its field. It provides foundational software, particularly in automotive, where we're the leader. But we're also in adjacent verticals, and I don't want that to be forgotten that this is only an automotive story. We're in medical. We're in industrial, we're in some near adjacencies, and actually we feel there's a long way to go on that side of the story. So we'll probably come back to that. Sorry, where are we going with this?
Any other an update on the macro?
The macro. Yeah, okay. So one of the misconceptions is that we're relying on the SAR, the level of global auto production, to drive this business into growth. I would say that's a slight mischaracterization. I would say it's more important the level of content per vehicle, how much QNX is going into each car. So if we look back, say, 2-3 years ago, you'd probably only see potentially one instance of QNX in a vehicle, probably powering the infotainment module, where there was the only place with high-powered compute. You fast track forward, you can have 3, 4, 5 instances of QNX per car. So we're not as reliant on the number of vehicles that get produced. However, clearly it helps if there are more. One of the main issues in the near term that's been a challenge for this business has been the pace at which automotive OEMs can develop software. So we've seen a significant pivot for traditional automakers from relying on tier 1 suppliers for their software to trying to do it all in-house, or at least most of it in-house. And actually that pivot has been a significant challenge. And for us, when programs to develop software slow down, it means that customers are consuming fewer development seats, as we call them, which is effectively a software development kit, or SDK, for using QNX. So whilst we've seen relatively stable to growing professional services that we provide, and also royalties from vehicles in production growing because of the greater content, we've seen some delays in programs, and those development seat revenue streams have been impacted.
That leads me to my next question. If I look at the backlog, that is just a metric you guys provide every year, that's how much revenue you guys have booked for QNX. I believe is the royalties revenue, in the backlog, right? So that's about 850 million. That's grown at a 30% CAGR, and that's about 4 times the fiscal 24 revenue. But then you're calling for medium-term guidance of about 14% revenue CAGR. So can you help us understand the growth of that backlog relative to what you're expecting for growth in QNX this year?
Yeah, great question. So the backlog represents a portion of our revenue stream. So royalties over time have kind of been somewhere around about 60% mark of our total revenue. So clearly it's important, but it doesn't tell the whole story. As I mentioned, development seats, when we got headwinds, that obviously lowers the revenue growth. One of the things with this business, it's a beauty and it's also a bit of a curse, is it's a very long life cycle business. So when you get into a new design, it's 2 to 3 years of design work before it enters production, and then maybe 5+ years of production after that. So you can be talking the best part of a decade of revenue that's coming from a design. So when we look at the backlog, it's growing very healthily and we're very pleased about that. But there is a bit of a delay, there's a bit of a lag before you start to see all of that come through into the P&L. I would layer on top that as a new management team, one of our philosophies is to try to be fairly prudent on our outlook too. There are some headwinds. You mentioned macro, I've mentioned development speed. You layer on those things, it does add some uncertainty. So we like to include that in our outlook guidance.
I mean, just given that the backlog has grown at a 30% CAGR, is it fair to assume that at some point the royalty revenue should be growing at a 30% rate?
I mean, in the fullness of time, if we keep adding at 30% indefinitely, then yes, it would translate to that. Now, obviously, we're not guiding on how quickly we're going to add to backlog. And the law of big numbers, as this thing keeps getting bigger and bigger and bigger, it becomes harder to maintain those rates. But nonetheless, it's very healthy, and for me, it's the best indicator of the overall health of this business into the long term. So right now, we couldn't be more happy with it.
Absolutely. Given that development has slowed down, some programs pushed out, some programs completely stopped, what does that do to the backlog growth potentially for this year? Just because programs have stopped, does that mean less gets added to the backlog this year?
No, not necessarily. Ultimately, this is a bit of an arms race for OEMs. They can't slow down in thinking about what their models are going to be like in 3-4 years' time. So whilst there's been some near-term challenges, and we do see some signs that that's starting to get better, they're still thinking ahead because they have to. And those designs they're contemplating now, they're committing to now, and it will enter into our backlog now.
Yeah. At your Investor Day, you highlighted a few growth opportunities for QNX. I think we just talked about some of them, higher content in the car.
Yep.
But you also talked about adjacent verticals. How are you going to move into these adjacent verticals? This is something that you guys have been talking about for a while now. What changes now that you've separated the businesses?
Yes. So now, as we said, it's really our core investment thesis right at this point in time, and to harness the potential of what is a very good QNX business. So when we think about capital allocation, clearly some organic additions to tackle those near adjacencies. So we very recently hired a new head of sales who came in to attack what we call the gem market. But beyond that, as we start to generate positive cash flow, which we think we'll do in the near future, we'll potentially look at some small tuck-in acquisitions that might fast track, be that any technology we need to add or potentially just go to market capacity that we need to add.
And then just final question on the EBITDA margin, you're calling for material expansion here. You did talk about some additional cost savings in Cylance. What are some of the other levers that you can get to help improve your margin?
Yes, so we've got a corporate cost bucket as well, as you'd expect from any public company like us. We've taken a significant amount of cost out of that, Dan, but there's still runway to go. I'd say we've taken the low-hanging fruit, so every extra $1 million we take out is going to take a little bit more effort than it has in the past, but we're very much focused on it. It's one of my key focus areas, and we're driving forward on that. Beyond that, it's really a case of top-line leverage, really, particularly on the QNX side, where we've invested a lot in R&D in recent terms to produce some of the new products that we've announced at CES earlier this year.
Tim, thank you so much.
Thank you, Dan.